Stop what you're doing. Close the other tabs. Put the phone down. Because what happened at 2 o'clock a.m. Swiss time today was not a rumor, not a theory, not a prediction about the future. It was a hard stop. At exactly 2 a.m., Switzerland froze silver exports, not slowed them, not capped them, not taxed them, frozen. In a single directive issued by the Swiss Federal Customs Administration, all outbound silver shipments above 1,000 kilograms were placed under mandatory export license review, with a stated processing timeline of 14 to 21 business days, minimum. No shipments clear customs during review. No exceptions. No fast-tracking. And this order was not sent to small traders or minor refiners. It was sent to PAMP, Valcambi, and Argor-Heraeus, the 3 largest silver refineries on Earth. Together, these facilities refine roughly 70% of the world's investment-grade silver. Let that sink in. At 2 a.m., the facilities that turn raw silver into deliverable bars stopped feeding the global market. The refineries did not shut down physically, but the outflow did. Silver is now trapped inside Switzerland. And I have the notice, the actual customs hold directive. Not a screenshot from social media, not hearsay. An official multi-language customs order issued under emergency provisions for strategic materials. When you understand what this document says, and more importantly, what it implies, you realize this is not a Swiss regulatory issue. This is the moment the global physical silver supply chain fractured, because silver is not like gold. Gold can sit in vaults for decades. Silver is consumed. Silver goes into solar panels, electronics, EVs, medical devices, defense systems, and coins. And that metal, the refined, deliverable metal, just got cut off at the source. This has nothing to do with COMEX charts. Nothing to do with paper futures. Nothing to do with algorithms or technical indicators. This is about physical metal, the kind you can hold, ship, mint, and install into machines. And that physical supply just hit a wall. Right now, dealers don't know yet. Mints don't know yet. Most of the media doesn't know yet. But the people inside the supply chain know. And they're already reacting. Before I show you the customs notice, before I explain why Switzerland did this in the middle of the night, you need to understand something most people never grasp. Switzerland is not part of the silver market. Switzerland is the silver market. And when the hub stops spinning, the entire wheel locks. In the next section, I'll show you exactly why Switzerland holds this power, how the world became dependent on 3 refineries in one small country, and why this dependency just became a global liability. To understand why this event matters, you need to erase a false assumption most people carry. Switzerland is not one of many silver refiners. It is the bottleneck. Globally, the world produces roughly 1 billion ounces of silver per year. That silver comes out of the ground in Peru, Mexico, China, Australia, Chile, mostly as byproduct from copper, lead, zinc, and gold mining. But mined silver is not usable. It's impure. Wrong form, wrong consistency. Before it can become a bar, a coin, or an industrial input, it must be refined to 0.999 or 9,999 purity and stamped with a hallmark the world trusts. That refining step is where the entire system narrows. Over the last century, precious metals refining consolidated, and it consolidated in Switzerland. 3 facilities dominate: PAMP Suisse, Castel San Pietro, Valcambi, Balerna, Argor-Heraeus, Mendrisio. All 3 sit in the same region, southern Ticino, right on the Italian border. Together, they process around 70% of the world's refined silver. Not mining, not trading. Refining, the most critical step. Why Switzerland? Because Switzerland built something no one else did. Decades of metallurgical expertise. Automated high-throughput facilities. Global accreditation. And, most importantly, trust. When you buy a silver bar stamped PAMP or Valcambi, the market doesn't question it. Dealers accept it instantly. Mints require it. Industrial buyers specify it. That reputation allowed Swiss refiners to scale while others stagnated or shut down. Even with high Swiss labor costs, it became cheaper to ship raw silver to Switzerland, refine it, then ship it back out than to refine locally in most countries. So the global pipeline evolved into a single structure. Mine gives Switzerland gives world raw material flows in. Refined silver flows out. The U.S. Mint depends on Swiss refined silver blanks. European dealers depend on Swiss bars. Asian buyers depend on Swiss kilobars. Industrial users depend on Swiss granules and powders. Everyone does. And here's the key point. Swiss refineries do not stockpile massive inventories. They run on throughput. They refine, ship, repeat. Which means when exports stop, there is no hidden buffer. There is no secondary hub ready to take over. There is no shadow capacity waiting to ramp. At 2 a.m., the hub didn't slow. It locked. Every shipment sitting in Swiss customs froze in place. Every new shipment was blocked from even entering the system. That's not a delay. That's a systemic halt. Now let me show you the document that did it. The exact language that turned a functioning global supply chain into a bottleneck overnight. Because once you read it, you understand this wasn't accidental. And it wasn't temporary. This is where speculation ends. Because what happened at 2 o'clock a.m. was not a market rumor. It was a written order. I received this document at 6:43 a.m. from a senior contact inside the precious metals supply chain, someone with direct operational relationships with Swiss refineries. The notice was issued at 2 o'clock Central European Time, January 12, 2026. It was sent simultaneously to all licensed precious metals exporters. Here is the substance of the directive, translated directly from the official German, French, and Italian versions. Swiss Federal Customs Administration Urgent Directive to Licensed Precious Metals Exporters. Effective immediately, 2 o'clock CET, January 12, 2026. All exports of silver in any form, including but not limited to refined bars, granules, powders, and semi-manufactured products, in quantities exceeding 1,000 kilograms per shipment, are subject to mandatory export license review. Shipments currently in customs processing are hereby placed on hold pending completion of review. Estimated review timeline: 14 to 21 business days minimum. Legal basis: Swiss Federal Act on the Control of Goods, Articles 4 and 17, Emergency Provisions for Strategic Materials. Justification: ensuring adequate domestic industrial supply and national economic security in light of extraordinary global commodity market conditions. This directive supersedes all existing export licenses and pre-approvals. Read that carefully. This is not enhanced oversight. This is not temporary paperwork. This is a hard stop. Every shipment already staged for export is frozen. Every new shipment must undergo a review that takes 3 to 4 weeks at minimum, and all prior approvals are void. Now let's talk about the 1,000 kilogram threshold, because this is where people misunderstand the scale. 1,000 kilograms equals 32,150 troy ounces. That's roughly 640 standard 1,000-ounce bars. Retail buyers never purchase shipments this small from refineries. Commercial shipments are 50,000 ounces, 100,000 ounces, 500,000 ounces, which means, in practical terms, every meaningful commercial shipment is frozen. This order doesn't affect hobbyists. It affects the entire wholesale market, dealers, mints, industrial buyers, all blocked. And notice the legal language: emergency provisions, strategic materials, national economic security. This was not a routine regulatory action. This was an emergency measure, executed overnight without warning under laws reserved for national interest crises. And here's the most important part. The directive does not specify an end date. 14 to 21 business days is the review period, not the duration of the policy. The policy remains in effect until revoked, which means Switzerland has complete discretion to extend, narrow, or permanently enforce this freeze, shipment by shipment. So the question becomes obvious. Why? Why would Switzerland, a country that built its wealth on open trade and financial neutrality, trigger emergency powers at 2 o'clock a.m. to halt silver exports? Governments don't do this casually. They do it when multiple pressure points converge, when delay becomes risk. In the next section, I'll break down the first crisis that forced Switzerland's hand, the one that quietly hollowed out refinery supply before anyone noticed. The first crack in the system didn't start in Switzerland. It started in China. On January 1, 2026, China quietly implemented a ban on refined silver exports. This wasn't a headline-grabbing announcement. No dramatic press conference. Just a regulatory change that immediately cut off roughly 400 million ounces per year of refined silver production from the global market. Most people stopped their analysis there. That was a mistake. Because the real damage wasn't just that China stopped exporting silver to the world. It was that China stopped exporting silver to Switzerland. Before the ban, China produced about 400 million ounces of refined silver annually. Roughly 30% of that production, around 120 million ounces, was exported. And a significant portion of those exports, estimated between 40 and 50 million ounces per year, flowed straight into Swiss refineries. Why would refined silver go to Switzerland to be refined again? Because markets don't run on purity alone. They run on standardization and trust. Chinese silver is often chemically pure, but Western markets demand specific bar sizes, hallmarks, serial tracking, and accreditation. Swiss refineries provided that final step. They melted Chinese silver, recast it into London good delivery bars, kilobars, granules, and powders stamped with PAMP, Valcambi, or Argor-Heraeus, and sold it globally at a premium. It was a highly profitable middleman role, and it vanished overnight. When China's export ban took effect on January 1st, that 40 to 50 million ounces per year of feedstock disappeared instantly. The Swiss refineries didn't have time to adapt. Mining output cannot be rerouted on demand. New supply cannot be conjured in weeks. Refining capacity means nothing without raw input. At the same time, this input stream collapsed. Demand exploded. Over the past 6 months, silver demand surged across every category. Retail investors, industrial users, sovereign buyers. Strategic stockpiling. Swiss refineries were already running near maximum throughput, shipping metal as fast as it was refined. Inventory levels were thin by design. So when the China inflow stopped, refinery management did something very Swiss. They ran the numbers. By the second week of January, internal reports showed that combined vault inventories across PAMP, Valcambi, and Argor-Heraeus had fallen to roughly 8 million ounces. 8 million. That sounds large until you contextualize it. Global silver demand consumes over 3 million ounces per day, meaning if exports continued uninterrupted, Swiss vaults would be empty in under a week. No buffer, no reserve, no margin for error. And this is the moment the situation crossed from market issue into national concern. Because Swiss officials weren't asking, will dealers have product? They were asking, what happens if Swiss domestic industries can't get silver? What happens if electronics manufacturers stall? Medical suppliers? Defense contractors? What happens if everything refined in Switzerland leaves Switzerland? That question had an unacceptable answer, so the Swiss government stepped in. The export freeze wasn't triggered by price volatility. It was triggered by a hard inventory reality. one that became impossible to ignore once China cut off the inflow and refinery vaults dropped to critical levels. And that was only the first crisis. In the next section, I'll show you the second force pushing Switzerland into emergency action, the one involving European governments, broken contracts, and industrial panic behind closed doors. The second pressure point didn't come from markets. It came from governments. As soon as China's export ban took effect and physical silver premiums began exploding across Asia, European industrial buyers panicked. Quietly, urgently, behind closed doors. These are not speculators. They are manufacturers. Solar panel producers, electronics firms, medical device companies, automotive and EV suppliers. And many of them rely on long-term silver supply contracts with Swiss refineries. Here's where the system began to tear. Over the last decade, industrial buyers locked in multi-year contracts at prices that made sense then, not now. Let me give you a real example. One of Europe's 5 largest solar panel manufacturers, a German firm, holds a binding supply agreement with Valcambi. Terms: 10,000 ounces per month. Fixed price: $82 per ounce, durations 3 years. This contract was signed in 2023, when silver was trading in the low $20s. At the time, $82 looked expensive, even generous. Today, physical silver is trading near $150 in open markets. That means Valcambi could sell the same silver elsewhere for nearly double. Do the math. $1.68 per ounce in opportunity cost times 10,000 ounces per month equals $680,000 per month equals over $8 million per year for a single contract. Multiply that across dozens of industrial agreements across Germany, France, Italy, and the Netherlands, and you're talking about hundreds of millions in foregone revenue for Swiss refiners. So refineries faced a brutal choice: honor contracts and bleed cash, or divert supply to the spot market and risk legal war. Industrial buyers knew this, and they were terrified. Because if refineries broke contracts, factories would stop. Production lines would go dark. Workers would be sent home. Losses would mount by the millions per day. So industrial buyers did what corporations always do when survival is threatened. They went to their governments, and those governments went straight to burn. Behind closed doors, European officials delivered a clear message to Switzerland. You cannot allow your refineries to abandon contracted industrial supply in favor of speculative export sales. You cannot let Europe's manufacturing base collapse because silver is chasing spot prices. Switzerland suddenly found itself trapped. On one side, refineries demanding freedom to sell at market prices, a physical shortage pushing prices vertical. On the other, European governments demanding contract enforcement, threats of lawsuits, trade retaliation, and diplomatic fallout. There was only one way to pause the conflict: freeze everything. By halting exports entirely, Switzerland created a cooling-off period. No shipments leave. No favoritism. No quiet diversions. Every shipment must now be reviewed to ensure priority allocation to essential industrial users before discretionary sales are allowed. This is why the customs directive explicitly references national economic security. It wasn't about protecting investors. It was about preventing a European industrial breakdown triggered by Swiss refineries chasing higher prices. And yet, even this wasn't the final trigger, because there was one more crisis, the decisive one, that made the export freeze inevitable. A crisis involving Switzerland itself. In the final section, I'll show you the third and most important force behind the 2 a.m. decision, the one involving strategic reserves, domestic survival, and why Switzerland ultimately chose itself over the world. The third crisis is the one that sealed the decision. It wasn't about markets. It wasn't about contracts. It was about national survival. Switzerland does not mine silver. Not 1 ounce. Every gram of silver used inside Switzerland, in electronics, medical devices, defense systems, precision instruments, must be imported, refined, and allocated. In normal times, that's not a problem. In a global breakdown, it's an existential risk. Which is why, quietly and without headlines, Switzerland began building a strategic silver reserve nearly 18 months ago. Not for speculation, not for profit, for continuity. Silver is a critical industrial metal. If trade collapses, if shipping lanes fracture, if sanctions spread, Swiss industry cannot function without it. So the Swiss National Bank and federal authorities set a target: 25 million ounces, enough to sustain domestic industry for roughly 6 months under severe disruption. By December 2025, they had accumulated approximately 12 million ounces. Halfway there. Then everything changed. China's export ban removed 400 million ounces per year from global circulation. Physical premiums exploded. Spot prices became irrelevant. And simultaneously, Swiss refiners reported their own vault inventories had fallen to roughly 8 million ounces. Now, do the math Switzerland did. Strategic reserve held. 12 million ounces. Refinery inventory remaining. 8 million ounces. Total accessible silver. 20 million ounces target. 25 million ounces. And that assumes nothing else leaves the country. If exports continued, even for a few more weeks, Switzerland would fall below minimum strategic thresholds in the middle of a global supply crisis. That was unacceptable. So at 2 a.m., Switzerland made a sovereign decision. Close the valve. Keep the metal. Secure domestic supply first. Exports became secondary. The global market became someone else's problem. And with that, the structure of the silver market changed. Not temporarily, permanently. Because even if exports resume months from now, trust is gone. Dealers now know Switzerland can shut them off overnight. Mints know supply is fragile. Industrial users know contracts aren't enough. Everyone will try to diversify. But here's the brutal truth. You cannot replace 70% of global refining capacity in months. New refineries take years. Equipment takes years. Expertise takes decades. So the short-term reality is simple. There is no adjustment mechanism, no cavalry coming. Which means the shock propagates outward. Dealers run out of inventory. Mints halt production. Industrial users ration or shut down lines. Physical premiums detach completely from paper pricing. Not because of speculation, but because metal is unavailable. This is how commodity shocks always work. China did it with rare earths in 2010. Prices exploded and stayed elevated for years. OPEC did it with oil in 1973. The market never returned to the old normal. Switzerland has now done it with silver. And the consequences are already unfolding. So what does this mean for you? It means availability matters more than price. It means premiums will look high until they double. It means paper silver becomes meaningless in a physical shortage. It means physical metal in hand becomes priceless. If you already hold silver, you hold leverage in a supply-starved world. If you don't, the window to act is measured in days, not months. Because once this becomes mainstream, once headlines hit, once dealer shelves go empty, the decision will be made for you. At 2 a.m., Switzerland closed the valve. The supply chain broke at the center, and now the countdown has started. This is not fear. This is not theory. This is policy. The metal is trapped. The market is exposed. And the shortage is no longer coming. It's here,